The stock market absolutely tanked in the last hour and a half of trading, and there are a couple reasons for this. First off, earlier today, the producer price index came out. Now, this is the cost of the raw materials within products. It jumped 0.7% in January, which was much higher than expected. Then, St. Louis Fed, James Bullard came out, and the Cleveland Fed office came out and said that they were pushing and they saw an argument for a 0.5% increase in the Fed funds rate this past month when they actually did a 0.25. Now, one thing to keep in mind, the St. Louis Fed chair and the Cleveland one do not vote on the interest rates in this session, so they were just saying they saw an argument for it. They still see an argument going forward as well. Whenever you see good employment numbers and high producer prices and consumer prices, you're sitting here and looking at it going, okay, this is inflationary. This is what the Fed wants to avoid. Are we getting closer to the goal of 2%? I don't know. Nobody knows. What we do know is that things are rarely going to go right in a straight line. It could happen. It absolutely can happen, but the market did not react well to these comments. Look at this. The S&P finished 1.26% down. 1.38. The Dow 1.26. And the NASDAQ, the tech-heavy, hype-heavy NASDAQ, 1.78%. At one point today, I think they were pretty close to even. Our charts don't do intraday, but if we just go to the intraday chart, no, it didn't get quite to even, but it was only down at one point today about 0.3%. And look at this, 3 o'clock, and about face, boom, just right straight down. That's when the comments started. Listen, we love low unemployment, but like I always say, low unemployment, anything you hear in the economy is not going to be a guaranteed good news. And everything you hear in the economy is not necessarily guaranteed bad news. It's always two sides to every coin. Low unemployment's awesome, but what does that mean? It means higher wages. What do higher wages mean? It means inflation. The cost of goods, the cost of services go up, then all of a sudden these people who sell these goods and services need to charge more money. That is inflation. Now, one thing that I want to talk about with inflation, this is a theory of mine that I've been working on for a long time about thinking, what is inflation? If you go back to 1929, I believe, inflation has come in at about 3%. However, if you look at income, median per capita income going back to 1929, that's more around 5%, 4.9 some percent. To me, that's the true inflation number. You can basket it any way you want with whatever goods. I look at inflation, historically it says 3%. I personally believe you look at income as what inflation will be. Because how can income really be much bigger than the cost of goods overall? Maybe about that basket of goods. And here was what triggered this years ago. I was reading about the cost of Wrigley Field. And I read 150,000, 250,000, but that was like in the early 1900s. And I'm like, what would that be today? It was like 150 million bucks or 200 million. So whatever the number was based on CPI. And I'm like, yeah, that's a lie. I also looked up today, the cost of the Titanic was $7.5 million back in 1912, which is equivalent based on CPI of like $200 million today. But if you adjust it based on income, just based on income growth, it's about $1.6 billion today. What makes more sense? The Titanic, an 800-foot vessel costing $1.6 billion or $200 million? Listen, there are so many billionaires out there who spend $1 billion on a boat or $500 million. I have a hard time believing the Titanic rebuilt today. These cruise ships, they're built and they're multi-billion-dollar cruise ships. And that's what made me decide to talk about it today. So when we talk about inflation, we talk about income. And as much as this country wants higher income, you don't want it to be too high too fast because the goods prices will increase very quickly, but incomes will take a while to catch up. And that's the issue the Fed is having to balance. Now, the good thing for the Fed is they have low unemployment. The Fed's actual goal is around 5 to 6% unemployment. We're currently at, I think it's 3.5%. If I'm the Fed, I'm looking at going, listen, we got 2% to deal with here. Let's keep raising rates up. It's okay. People are going to lose their jobs, according to them. But if we increase the inflation, if we increase unemployment to 5.5%, we could probably put a big hamper on inflation. And that's what their goal is. Because right now, people are complaining about inflation. Why? Because everybody has jobs. Everyone has jobs. At 3.5% unemployment, unless you're in between jobs, you have a job. So the U.S. federal government is sitting there saying, okay, let's take this 3.5% unemployment for a ride. Let's sit there, ride its coattail as much as we can, make sure that unemployment goes up a little bit, but we keep prices down a little bit. It's harder to find workers as businesses out there when unemployment's so low. I go to McDonald's every morning. I'm still floored that the McDonald's I'm at still has the same employees that they've had for 5-6 months. I can't believe that. I'm absolutely floored by that. And every morning I usually get a hash brown and a large Diet Coke light ice. But this morning I didn't get the hash brown. And the guy at the window said, "No hash brown today, huh?" I said, "No hash brown today." But that's how long the guy's been there. And I was actually floored by that. I was like, wow, these guys have been here for a long time. It's McDonald's. Why? They're starting to pay very competitive wages. And the kid at the window who said this to me is a college student. Because I hadn't seen him in a while. I'm like, "Hey, you're back." He goes, "Oh, I never left. I was working a different part." I was like, "Oh," I go, "What happened?" He goes, "Well, I was busy with school, all that stuff." I'm like, "Okay, sounds good." So CPI, these inflation numbers, I want us to focus. I'm still going to talk about CPI. I'm still going to talk about producer prices. But at the end of the day, what I'm going to focus on is wages. I'm going to look at median income. And right now, the median per capita income is like $75,000 a year. Back in 1929, it was $834 a year. Think about that, guys. $834 a year less than 100 years ago. That means the average person makes 90 times more today than they did 94 years ago. That's pretty incredible. And that's the whole part. You can't just look at one thing and say this answers everything. You look at everything combined. Now, there are a few factors that are going to drive things. To me, wages drive a lot of everything we do. We don't want deflation. 1929, 1939, we saw incomes go down. We had deflationary environment. The reason that's worse is we don't want people deferring what they buy because they're like, hey, if I just wait a little bit longer, I can save even more money. We want them to sit there and spend money going, hey, like I'm doing a house right now. And all I think to myself is, I might as well sign up for it now because if I don't do it today, if I do it 2 years from now, it'll probably cost me a ton more money. And the money's in my account anyhow, I might as well buy it. That literally goes through my head a lot. I've literally had that conversation with my fiance multiple times where she says, we talk about the budget and she goes, "Oh, this is going over budget." I'm like, yeah, but if we're going to do this anyhow, we might as well do it today. Because if I did it 2 years ago, it'd have been a lot cheaper if I'd done it 2 years ago. So these are the things, these are the ways to balance. But guys, at the end of the day, this market has been very much held up with 0% interest. These hype stocks, it's easy to take risks when interest rates are 0 because you're like, oh, what's my risk? But now 90-day Treasury pays 4.8% almost. There's a lot better return than 0%. That same 90-day Treasury in the last 2 years was 0.06% annualized. Now it's 4.77. The 10-year is 3.84 today. The 10-year got as low as 1.5%. That's a huge difference. And these are the things that play out. But they affect stocks a lot because of one reason. When interest rates are low, you look at the dividend yield. Oh, I can't get any money from my savings account. I might as well invest in stocks. At least I get a dividend. And what does that cause? That causes people to keep buying and buying and buying and buying and buying. And it self-perpetuates that pattern of, oh, look, I bought back here. It went up. I'm going to keep buying here. But eventually that has to end. And a big trigger that starting to cause this is rates going up. But my comment to you was, go look at our past videos. All we said was, rates can't stay this low forever. Just like if rates were 15% today, I would say rates can't stay this high forever. It's both ends of the spectrum. There's going to be somewhere in the middle. The historical average for the 10-year Treasury is 4.4 to 4.6%. So we're almost there. We're almost there right now. But we swung from one pendulum and maybe we go to the other one. I don't know. But I have no idea where interest rates are going to go in the short term or even the long term. My guess is it'll be somewhere on the average over an average period of time for the next 20 or 30 years. But if you bought stocks based on 0% interest, it might be hard to justify those returns. And you should expect volatility. And that's where we stand. So if you like this, guys, subscribe to the channel. Even if you don't agree with me, there's common sense involved here and analytics involved here. So I appreciate your time. Thank you very much.